What if I told you the job that pays the most isn't always the job that makes you the most money? It sounds backwards, but stay with me. Your paycheck is only part of the equation. Benefits are part of your compensation too, and they can either help you build your future or cost you thousands. Today we're breaking down workplace benefits, from retirement and healthcare to the perks that create a better work-life balance, so you can go from working for a job to making your job work for you. Let's start with retirement benefits. Because whether you're beginning your career or closing in on retirement, planning matters. A quick note before we dive in. I'm not a financial advisor, and this is not personalized investment advice. This is just to help you understand your options so you can make informed decisions. All right, let's get into it. The most common employer retirement plan is a 401k. A 401k lets you invest money directly from your paycheck into stocks, bonds, mutual funds, and other investment products. While the stock market goes up and down, historically, investments tend to grow over the long term. One of the best benefits a company can offer is a 401k match, where your employer also contributes money to your retirement savings based on what you put in. That's basically free money. But anytime anyone offers you free money, there's usually a catch. Some companies have a vesting period, meaning that you have to stay there for a certain amount of time before the employer contributions fully belong to you. If you leave too early, you could lose some or all of their portion. Another big advantage of retirement investing is compounding interest. That's when your money earns money, then it's reinvested to earn even more money, and so on and so on. It's basically a financial snowball. The earlier you start, the more time the snowball has to grow, which can mean the difference between hundreds of thousands of dollars by the time you retire. There are two main types of 401ks, a traditional and Roth, and the big difference between them is taxes. With a traditional 401k, contributions come out before taxes. With a Roth 401k, you pay taxes first, then your contribution is based on the amount left over. Why would anyone choose a Roth? Again, taxes. With a traditional plan, you pay taxes later when you withdraw the money. Since Roth taxes are paid up front, qualified withdrawals in retirement are tax-free. One important thing to know is that these accounts are designed for retirement. If you withdraw money before age 59 and a half, you could owe taxes plus a 10% IRS penalty. But what if you change jobs? You can usually do a rollover, moving the money to another 401k or an IRA without penalties. IRAs are individual retirement accounts, similar to 401ks, but you don't need an employer to open one. A central credit union offers fixed-rate IRAs for people looking for steady, predictable growth. For someone interested in putting money in the market, a Centra's Retirement and Investment Services team can help explore investment options. Some employers offer pension or profit sharing. A pension is like a paycheck after you retire. It provides guaranteed income based on your salary and years of service, and some plans allow you to pass the pension on to your spouse after you pass away. Profit sharing is different. It's when a company shares part of its profits with the employees, often through 401k contributions, company stock, or cash bonuses. Now that we've talked about benefits that help you grow your money, let's talk about benefits that protect it. Let me ask you something. If you owned a machine that made you money every day, you'd take care of it, right? Well, that machine is you, and insurance is one of the ways to protect it. The problem is insurance can get confusing fast. Your HR team hands you a benefits packet full of information, and before you know it, you're expected to sort through it all and make the best choices for you and your family. So let's simplify it. Your premium is the amount you pay to keep your insurance active. Your copay is a fixed cost for doctor visits or prescriptions. The deductible is the amount you pay out of pocket before insurance really starts helping. After you meet your deductible, coinsurance kicks in. That's a percentage you and the insurance company split, and percentages vary by insurance provider. For example, if you have a $2,000 deductible and an 80/20 coinsurance, you pay the first $2,000 yourself. After that, insurance pays 80% and you pay 20%. That may not seem too bad on a $3,000 bill, but on an $80,000 hospital stay, it makes a huge difference. That's why your out-of-pocket maximum matters. It puts a cap on the total you have to pay in a plan year before insurance covers the rest. Using the earlier values and a $4,000 out-of-pocket maximum, you would pay $2,000 for the deductible, another $2,000 to meet the out-of-pocket maximum, and then you're done. Insurance would be responsible for the other $76,000. That's with a $4,000 maximum, but this can be much higher. According to healthcare.gov, some 2026 marketplace plans have out-of-pocket maximums over $10,000 for individuals and over $21,000 for families. Sometimes the plan with the lowest monthly premium isn't actually the cheapest plan if something major happens. But how do you pick the right coverage for your budget? There are many types of insurance plans, and not every employer will offer every option, but I'm going to share with you the most common. A health maintenance organization, better known as an HMO, usually has low premiums and deductibles, but comes with a different cost. HMOs limit your in-network provider and require a referral from your primary care physician for services they don't provide. Being limited to in-network care means if the provider you've used for years isn't part of the approved network of physicians, you either change providers or pay 100% of the cost. A preferred provider organization or PPO plan gives you more freedom, but typically has higher premiums. PPOs generally don't require specialist referrals, saving you time and money, plus you can see out-of-network providers. Then there's the High Deductible Health Plan, or HDHP. These plans typically come with, you guessed it, a high deductible, but also usually have high out-of-pocket maximums. They can be expensive for someone with a pre-existing condition or families with children since they tend to go to the doctor more often. But they also have some of the lowest premium costs, so they can save money for healthy people who don't need much care. One big advantage of high deductible health plans is they can qualify for an HSA or health savings account, which your employer can choose to contribute to as well. HSAs offer triple tax benefits. You contribute money tax-free, the money grows tax-free, and qualified medical withdrawals are tax-free. Plus, unspent funds roll over each year. You can open an HSA at many financial institutions, including Centra. If you don't have a high deductible health plan, you may be offered an FSA, also known as a flexible spending account. They also let you use pre-tax money for medical expenses, but they're more restrictive. FSAs have rollover limits, meaning anything over that is use it or lose it. So if it's December and you still have FSA money left, you may want to start stockpiling Band-Aids, cough drops, and ibuprofen, or forfeit the funds. You can also use HSA and FSA savings for dental and vision expenses. Dental insurance typically covers exams, cleanings, x-rays, and fillings, but may not fully cover the bigger expenses like braces or dentures. Vision insurance helps pay for exams, glasses, or contacts, but LASIK surgery may still come out of your own pocket. This is where a lot of people stop reading their benefits package. They pick health, dental, and vision, then ignore the rest until the next open enrollment. But some of the most important coverage is hidden in those last few pages. Disability insurance helps replace your income if you're injured or too sick to work. That can be short-term or last for years. And life insurance protects people who depend on your income. Many employers offer small, basic policies, but also allow employees to purchase additional coverage. That can be especially helpful for people with health conditions that make private insurance expensive or unattainable because you may not have to do lab work to qualify. Now, your benefits aren't just about preparing for retirement or worst-case scenarios. Some benefits are about actually enjoying life right now. Because as important as work is, everyone needs a break from it sometimes. Vacation time gives you a chance to rest, travel, spend time with family, or simply take a moment to relax at home without checking emails. And that matters because burnout is real. Paid sick leave is just as important. It covers your pay for time away from work while you're feeling unwell, giving you time to heal and get better. Many employers now combine vacation and sick hours into general PTO or pay time off that you can use however you need. Holiday pay works differently depending on the company, either giving you extra pay for working on holidays or paid time off when the holiday falls on a normal workday. If your family is growing, parental leave can provide paid time off after the birth or adoption of a child. Some benefits are more situational, but still really important. Bereavement benefits gives people time to grieve and attend funeral services without having to worry about losing pay. And jury duty pay helps cover your income while you're doing your civic duty. In Iowa and Illinois, courts often pay jurors less than $50 per day. And if your employer doesn't pay you during jury duty, it can hit your budget hard, especially if you're in a week-long trial or more. Ultimately, your benefits aren't just extras that come with a job offer. They can help shape your entire financial future. The right benefits can give you more freedom and peace of mind throughout your life. Being financially successful isn't just about how much money you make. It's about the choices you make and how those choices affect your goals. Whether that's retirement savings, taking care of your health, or making more time to spend with family. Look beyond the hourly rate or salary and get to know the whole compensation package. You don't have to do it alone. Professionals at Acentra can help you start an IRA, open an HSA, or even help you plan for the future with personalized guidance. Because when you take control, learn to understand your benefits, and know where to turn to fill in the gaps, you can stop paying attention to the paycheck and start focusing on the future.